Okay, welcome to the importance of cash flow. We have Jim Dannhauser from the SCORE Cape Cod chapter, and we're very pleased to have him presenting this topic again. He does it very well, so you're going to learn a lot today. But as we get started, we do want to review a few things about SCORE. One, we do put out what we call a business essential series. These are the topics for that we're running this late spring, early summer. We do have a couple left coming up. So if you haven't attended any, please take a look at the future ones. And if you missed any, please go look for the previously recorded versions on the score.org/Boston website. They're all listed there for you to watch if you've missed any. We also want to make sure that you know all the things that SCORE does and what our goal is. And our goal is to share small business information with you. We do that through our website, score.org. You're going to find podcasts, blogs, articles, templates, lots of great information for you to look through. We do that through our workshops and webinars. We advertise those through social media, our newsletter, and on the website. I think the most important way we share small business information is through our mentorship program. And our mentors are all volunteers. They come to us with a variety of skill sets and experiences that they've learned from that they want to share with you. We work with anyone in the small business journey, whether you're trying to decide if you should be in business, whether you're in the planning phase, in your business, growing your business, or ready to leave your business, whether it's by selling or exiting your business. So we're there for the whole journey. So mentors, usually you start with an initial mentor and then others are brought in as your needs change and grow. So it's a wonderful collaboration and team building. I'm just stumbling over my words today. I apologize. Team of experts to assist you and help you be successful. So getting a mentor, very easy. There's many ways on the SCORE website to do that. Probably the easiest is let us do the matching for you. You just put your zip code in and that matches you to the chapter that is nearest you. There's a little form that pops up. And we're looking for a little bit of information like what type of business and how we can help you in the moment. And that's what we're going to use to match you to the appropriate person. So a little bit about today. I do prefer if you could use Q&A. It is much easier to keep track of questions. Those would be questions for our presenter. We'll make sure we try and hit all questions as possible. We are recording, and the recording will be posted score.org/Boston. It'll be on the blue bar, local workshops under previously recorded. And we'll also be sending out a little follow-up email as well with that recording link and the templates that we'll be talking about today. So let me pull that down. And we do want to thank, even though they weren't able to join us today, we do want to thank Eastern Bank for sponsoring this topic today because it is a very important topic. So yeah, I will introduce you to Jim Dannhauser. Oops.
Good morning, everybody. Thanks, Teresa. As Teresa mentioned, I'm Jim Dannhauser. I'm a volunteer mentor with the Cape Cod and Islands chapter of SCORE. And I'm here today to talk about what I regard as a very important topic for any small business owner, and that is cash flow management. By way of my background, I started my career as an attorney with a large law firm in New York City. I moved into investment banking, serving as a financial advisor to a lot of small and medium-sized businesses, including one family who I was working with. And they convinced me to become a member of the board of directors of one of their companies and eventually to become its CFO. We grew that company and took it public. I left that business in early 2006, served for a while as a senior advisor to a large private equity firm, and then together with a partner made a number of investments of my own funds in small businesses, all of which I have now successfully exited from. So I have seen small business life from any number of contexts and any number of cycles, and have seen up close and personal just how critical the intelligent and proper management of your liquid resources really is to business success. If you have questions at any point in time, you'll see there my contact information, my SCORE email address.
Hey, Jim, can you put this out into slideshow? We're kind of seeing your whole desktop.
Okay.
We expand it out. Okay.
It's trying. There it is.
There we
How's
go.
that?
Thank you so much.
Okay.
Perfect.
One other thing is that what I wanted to make sure we do is to have some give and take during the course of the discussion. One of the negatives about doing these sessions virtually is that you lose the personal contact with your audience. So please, as you have any questions that occur to you, put them in the Q&A, and Teresa will pass them along to me as and when it's appropriate. So with that done, let's talk about what we're going to try to cover today. We're going to do just a brief overview of financial statements. I don't want to try to make anybody here an accountant if they're not already, but it's important to understand what financial statements can tell you. We'll touch also very briefly on startup costs and budgeting, although startup webinars abound on the SCORE system. And if you're engaged in thinking about a startup, I would encourage you to look there. We'll spend most of our time talking about cash flow statements, cash flow forecasts, and how you can use those instruments to make sure that you stay on top of your cash resources. So, what is the objective of a financial reporting system? And everybody should have a financial reporting system of one form or another, whether that's QuickBooks Online, whether that's simple bank statements and Excel spreadsheets, but you should have a financial reporting system that you can use to track your business. The goal is to make sure that you have in hand accurate and complete information in a timely fashion so that you can make smart decisions about your business. You're making decisions about your business all the time. And if you don't really understand what your financial position is, you run the risk of making bad decisions, which can get you into trouble. So the key is being accurate and being complete, and avoid garbage in and garbage out. So there are three basic financial statements. The first is a balance sheet. That shows you the snapshot of what the business owns and what it owes, and it speaks as of a specific date, typically the end of the month, the end of a quarter, or the end of a year. The income statement covers a period of time. It's also called the P&L. It shows the results of the business operations for that defined period of time. Again, it may be a month, it may be a quarter, or it may be a year. The cash flow statement, like the income statement, speaks as of a period of time, and it shows where the business's cash has come from and where it has gone over that defined period. And it is, for small businesses, far and away the single most important of your financial statements. There's another important financial document, which is not technically a financial statement. It's a budget, which reflects your forecasted performance over the next period of time. Now, I mentioned startups. Now, all startups need to prepare a cash flow budget showing development and planning and getting ready to operate. Why? Because you need to understand how much cash you're going to need in order to be successful. You should show whatever cash you're going to require for an initial period, which may be 6 to 18 months, to where you get to a break-even point. Break-even simply means that point where your cash inflow is equal to or greater than your cash outflow. You should make sure that you include a contingency, because in the history of business, no startup has ever gone exactly as it was expected to go when it was initially put together. So you need to have a contingency to make sure that you can get to that break-even point. But as I said, there are a lot of other webinars which focus exclusively on startups. So if you're in that mode, I would encourage you to look for those at the score.org website. So what's cash flow? Quite simply, cash flow is the movement of cash in and out of your business from every source, whether that's sales, collections of receivables, sale of assets, ordinary operating costs, debt costs, asset purchases, etc. So it picks up every dollar that comes into your business or goes out of your business. As I said, it looks at those inflows and outflows over a specified period of time. And you should really develop the ongoing discipline of looking at your cash flow statement at least as frequently as monthly, because that's the only way to know where your cash is coming from and where it's going. Importantly, some people don't necessarily understand this, but you could show a profit on your P&L statement, but still lose cash. Maybe you bought assets. Your depreciation expense, which is non-cash, will hit your P&L, but it won't hit the cash flow statement. You may be buying significant amount of inventory, which will not hit your P&L till it's used, but you're still burning cash. That's why for a small business, it's cash flow that you need to pay most attention to. So how do you prepare a cash flow statement? Well, the simple way is to use your accounting system if you have one. Most people do. QuickBooks Online, one of the others, you can easily generate a cash flow statement right from that system. If you want to dig a little deeper, you could look at that blog that I've referenced here. It's a very good, simple to understand blog, which tells you what goes into the calculation of cash flow for your business. And also you can get a template off of the score.org website. And I want to show you what that template would look like here. Teresa, can you see that?
Sorry, you stopped your share. You need to bring your share back up. Your share went down. Sorry.
So it did.
Now we can see it.
Okay, perfect. This is a template that is available to you on the score.org website. It's a very easy to fill out cash flow statement. It shows all the cash that has come into a business, whether that's from cash sales, collections of receivables, or other cash injections, and all the cash that goes out. A very simple format that you can use, which will help you to make sure that you are generating a comprehensive cash flow statement. I also want to show you an example of a cash flow statement. Can you see that, Teresa?
I see the score sample.
Okay.
Great. I see it.
Okay. So just to give you an idea of what a cash flow statement would typically show you, you see the cash at the beginning of the period. That's where you always start with the cash flow statement. The cash at the end of the year. Accountants like to put the cash flow statement into 3 separate buckets because it helps you to analyze where your cash is coming from and where it's going. So the first bucket is cash flow from operating activities. You see, it picks up all of the ordinary activities of your business. Cash paid out, cash received, wages, interest, etc. Then you have cash flow from investing activities, which will be any capital assets that you either purchase or sell. And then cash flow from financing activities, which shows you any bank borrowings or bank principal repayments. The purpose of this is so that you can understand what a cash flow statement is telling you. And it's simpler to see it in these separate buckets. So that's why accountants will generally do that for you. Okay, you've heard it 1,000 times, cash is king. There's a reason you've heard it that many times. It's because it's true. In fact, if you look at business failures for small businesses in particular, most of them can be traced to cash flow problems. Why? Well, small businesses don't have nearly as many levers that they can pull to deal with cash flow shortfalls as a larger business does. And running out of cash is death for a small business. I used to tell people who worked for us that we could survive to fight another day so long as we didn't run out of cash. I have a colleague who thinks that there are two principal functions that any business owner cannot delegate to somebody else. First is sales, and second is managing cash. You have to stay on top of your cash resources and your current and future cash needs to avoid a liquidity crunch. Now, there are some simple things that you can do which can make your life easier. First off, if you don't already have it, you should absolutely keep a separate bank account for your business. If you come away from this session with nothing else, come away with that. Why? Well, it's very simple. You can then run all of your business receipts and expenses through that bank account and none of your personal expenses. And it becomes a very easy way for you to monitor your cash position. Virtually every bank now has portal opportunities where you can go on and look at your cash balance every day. And you can see what hit the account every day. And if you don't separate out your personal and business, life becomes much more difficult for you. You can't really tell what your business is doing. I had a client once who didn't do this, and it took several weeks of significant effort as they were getting ready to try to make a bank loan borrowing to strip out all of the personal expenses that were affecting the business. You just don't need to do that. Keep a separate account and use it only for your business. It's an easy way to monitor cash, and it makes tax return preparation an awful lot easier. Your accountant, if you have one, will be very happy because it ensures that they can look at it and see exactly what came in and what came out. You should also keep a separate credit card for your business if possible. Why? Well, because you will begin to establish credit for your business. And just as importantly, there may come circumstances in which you need to buy something for your business, whether that's inventory or equipment, and you don't have any cash available to cover it, and you don't have any loan capacity available to you. So you can accomplish that purchase with the credit card. Now, sometimes people say, well, debit card does the same thing. I could use that. Well, a debit card only works to the extent you have cash in the bank. So if you can keep a separate credit card for your business and use it only for your business, it's a valuable tool to have in your toolbox. But be sure that you do your best to pay those balances back on time. If not, then pay them just as rapidly as you can. Because as everybody knows, credit card costs are among the highest interest costs that you might incur. So pay them back as soon as you can, but utilize them as a tool when necessary. As I said, you should look at your cash flow statement at least monthly. You should keep a cash flow forecast for your business covering the next 12 months and keep it updated. And we'll talk a bit about cash flow forecasts and their importance in managing your business. You should maintain good accounts receivable collection practices, and we'll talk some about that as well. And you should avoid overdoing it on supplies, inventories, and equipment. Why? I know everybody wants to have everything they might ever possibly need to run their business. But don't go there. Get what you need, not what you wish, because all of those purchases eat up cash. And I have seen retail clients get in trouble because they overbought inventory and found themselves in an unexpected cash crunch. Now, as I said, you should prepare a cash flow forecast every year as part of your annual budgeting process. But just don't prepare it and then stick it on a shelf and say, okay, that's done. You need to look at it periodically and update it for changed circumstances. So every month, at least, you should be looking at your forecast and changing it to reflect what actually happened and what that means for what is likely to occur over the intermediate term. And if you see yourself with a cash flow shortfall on the horizon, look carefully at that cash flow forecast for the next week and next month to see if there are immediate issues that you need to attend to. Because you will find that cash flow difficulties increase logarithmically. That is to say, as they begin to hit, they hit hard and fast. So you need to anticipate issues and take action while you still have the time available to you. Because things change, and you need to reflect the impact of those changes on your business. It's all about trying to make smart decisions about your business. But you can't do that unless you can see what your cash situation is going to be over the next 12 months. You may be thinking about hiring additional people or buying equipment or taking on work. A lot of people don't understand that typically when you take on additional work, you're going to have some upfront cash expenditures associated with putting yourself in a position where you can do it before you get the revenues from it. You may need to take some steps to reduce expenses. All of those things require you to understand where your liquidity is and where it's going to be over the next 12 months. And I know I'm focused on this more because I'm on the Cape, but you should always bear the seasonality of businesses in mind. I know people on the Cape who've been very happy in June, July, and August because things are humming. But in my humble experience, so far at least, every year has also had a January and a February and a March when things will be much slower. And if you don't plan for those slower periods, you'll find yourself in a tough spot. So what do? If you see a cash flow shortfall on the horizon, take steps to deal with it early. You can seek working capital or other loans. You may reduce unnecessary expenses. You may need to reduce staff. You may need to defer paying yourself for a period of time. You may need to delay purchase decisions or try to accelerate collections. But all of those things need to be proactively dealt with if you see a cash flow shortfall coming down the pike. If you have near-term real shortfall issues where you're just not going to be able to pay certain bills, you may need to consider meeting with the parties you owe money to explain the situation and tell them when payment will be made. But be careful here, because you do not want to get into a situation where rumors start to spread about you're having cash flow difficulties, where you may end up with a problem with suppliers and even customers. So be careful, but take whatever steps you need to do to make sure that you manage the situation. And from the get-go, you should always try to keep cash reserves and or establish a working capital line of credit to help you to deal with shortfalls that may come your way. Now, I want to bring up a cash flow forecast. Can you see that, Teresa?
Yes, we can.
Okay, thanks. So this is a simple cash flow forecast I put together just to serve as an example of what can happen to you if you're not careful. You'll see a reference there to a YouTube video, which is quite good. It's how to accurately project cash flow, your complete guide. So if you want to figure out in detail how you can prepare a cash flow forecast quite easily, I would recommend you invest the 20 minutes of watching that video, because you'll come away from it understanding the mechanics of what you should be doing. So this is a business that, and don't worry about the specific numbers, they're just examples. It's a business that started the year with $20,000 in cash. It ended the year with $11,000 in cash. The numbers aren't significant except for the story they tell. How did they get there? Well, they brought in $700,000 and it had an outflow of $709,000, which accounts for the differential. But that's okay. They're still sitting with a positive cash balance at the end of the year. But look what happened to them in March. They suddenly had an $11,000 cash negative. Why? Well, you can see they made some inventory purchases in the first 3 months of the year as they were building up for their season. Well, if they had a forecast in hand and understood that those purchases were going to put them into a negative cash position, they could have had the opportunity to do something about it in advance. They could have delayed some of those inventory purchases. They could perhaps have purchased some of that inventory on credit. They could have, because oftentimes you can use either a credit card or an inventory supplier who will be prepared to extend credit to you for that inventory. But if you didn't know you were going to go negative, because you had a good forecast in hand, then you wouldn't know that you needed to be thinking about how you approach that. Also, you'll see here in June, they had another negative. Again, the numbers aren't significant in terms of their absolutes, but it's the principle of how they got here that makes a difference. You'll see in June, they spent $20,000 on a piece of equipment. Well, if they knew that they were going to be back negative, they might not have done that. They might have delayed that purchase, or they might have sought to buy it on credit. Because oftentimes, equipment suppliers can be the most ready source of financing for a small business. Why? Well, because the equipment supplier is comfortable dealing with the equipment. They have a dealer network, perhaps. They will be comfortable if they have to take the equipment back because you can't pay for it. So these are just some of the things that a well-done cash flow forecast will tell you if you have one from the beginning of the year and you keep yourself current on what the impact of your decisions are going to be. Okay, accounts receivable. And this is a big issue for many small businesses. And in my experience, I've seen it cause as many liquidity problems as almost anything else. Now, you may be in a business where you don't run up accounts receivable. Perhaps you're a retailer or you run a food outlet or restaurant. In that case, good for you. You don't have this issue. But if you do, you should develop and maintain good practices dealing with those receivables. These include, most importantly, timely billing. I've had a number of clients who just didn't do this, and it hurt their cash flow. You should get the bills out as soon as the work is done. Don't wait till the end of the month. Get them out right away. State what's been done and what's owed and when the payment is due. Now, most accounting systems have invoicing tools that you can use, which will enable you to do this very simply. They will spit out the invoices and you can get them out the door. And it also enables you then to track the payments that are come in efficiently and integrate it with your accounting system. We would recommend that you don't just send the bills out by regular mail, send them also by email, and communicate with your customers and ask them how they'd like to receive their bills and make sure that you get them to them. Make it clear how the check should be made out and where they should be sent. I can't tell you the number of times I've seen clients who just didn't do that. They just sent the bill. The clearer your instructions are, the clearer the statement of the work that's been done, the more likely you are to have timely collection of your receivables. You may want to consider adding instructions for online payment or credit or debit card payments if applicable, because most systems will now enable you to do that. And you ought to think about getting to know who at your customer is going to be actually making the payments and communicate with them regularly. You also ought to monitor your collection processes. Make sure you get notices out when payments are late. Most accounting systems will enable you to look at your accounts receivable in an aging process. So you can see quickly what accounts are more than 30 days due, more than 60 days due, and more than 90 days due. Once the due date is passed, you should reach out to your customers by email or phone. You don't want to be an annoyance, but you do want to make sure that you get paid for work that's been done. Now, what do you do if you're just not getting paid? Well, you can send a formal letter, which shouldn't be threatening. It should just be for collection. For longer delinquencies, you can consider legal action, including small claims court. Now, there are expenses involved with that, both in terms of money, even in small claims court, and your time. I have a client who simply insists upon going to small claims court if they're not paid. And I understand why. They want to make sure that people understand that they need to be paid. You don't want to necessarily get a reputation as the tough person to deal with because you may lose customers that way, but you simply don't want to be taken advantage of. But in my experience, A significant percentage of the time when somebody is not paying you, it's because they can't. So check the ability of the debtor to pay and be prepared to cut the price and collect what you can before you worry about proceeding. And by all means, be prepared to fire a customer. You should not continue to do business with customers who simply aren't paying you. You might also consider early payment and prepayment discounts for customers. Now, this can sometimes be something that people regard as controversial, but I'm not talking about a 30% discount. I'm talking about providing people a 5 to 10% discount for prepayment or early payment. For example, where I used to live, I had an in-ground sprinkler system, and that company who serviced the system for me would give me the option of paying the full annual basic fee if I paid it before the end of March with a 10% discount. They did that because they wanted to minimize their accounts receivable, but it also gave them the benefit of having some cash inflow in what they might consider their slower months. You can also consider getting credit card authorization for regular customers and charge their card after the invoice is approved. But make sure you safeguard that information if you get it. If you're in the service business, you might also consider using mobile payment apps. They work great. There's a small fee associated with it, but the less time and agony and hassle you have to spend dealing with receivables, you'll find it to be the better part of valor. I had a fellow who used to come and service the gas fireplaces that I had. He would just take my credit card, swipe it, and be paid before he left the house. It's a lot simpler and can make your life a lot easier. So think about that as another option for dealing with receivables. And on bigger projects, if you're in a construction business, create a payment schedule that works for you and make sure you get enough upfront so you're not going out of pocket for significant amounts of supplies. Some other working capital tips. You might stop and say, okay, Jim, what the heck is working capital? Well, it's a fancy financial term for a very simple concept. Working capital looks at your current assets, cash, receivables, and inventory, as compared to your current liabilities, your payables, and your short-term debt. It tries to look at what is your capacity to pay your bills as they come due. If you have greater current assets than current liabilities, you have positive working capital. If you have negative, that means that your current liabilities are larger than your current assets, and it's signaling that you may have a problem, so you need to deal with it. As I said before, you should really consider avoiding overbuying inventories, supplies, equipment, and the like. I've seen it happen many times where people just get into trouble because they overbought inventory for the retail outlet and it wasn't being sold. If you find yourself in that situation, you may have to bite the bullet and start putting it on discount and moving it off the racks because it is effectively your cash, and the more cash you can get for it, the better. Whenever you're making a purchase decision, do it with the impact on your cash flow forecast top of mind. And you should pay your accounts payable on time. Everybody wants to be a good customer, but don't pay them early. If somebody gives you 30 days or 60 days to pay a bill, pay it on the 30th or the 60th day. You don't know what's going to happen in the intervening time period. You may find yourself needing that cash. So take advantage of terms that people give you. You want to be a good customer, but you don't have to be extra good. And do not use any tax withholdings, whether that's employee tax withholdings or sales or meals taxes, as your cash. It is not. Make sure those payments are made over to the proper authorities on a timely basis. I have seen people who hit a temporary, or so they thought, cash flow problem. So they started using sales tax receipts to cover needed expenses. figuring, well, things will be better shortly and I'll be able to make it up. If it isn't, you've got a real problem on your hands because that's a violation of law. You can find yourself with significant penalties. So you should not be using any of those withholdings as your funds. They are not. Okay, so let's talk a little bit about financing because it is one of the ways that small businesses can address themselves to cash needs. You see listed here the usual sources of funds. You've got family and friends. Now, that doesn't just include the people who sit at your dinner table with you. It's people in your circle who you are comfortable talking about making an investment or a loan to your business. You'll have your personal savings and your personal assets. These are issues of what your appetite for risk is. Do you want to use a significant portion of your personal savings or assets to support the business, or don't you? There's no right answer to that. There's simply a question of what your own personal risk appetite is. You can also use some of your retirement savings, whether that's through an IRA or otherwise. But be careful, because if the business doesn't succeed, you may have lost whatever nest egg that you might have had. Credit cards I talked about, they do have a high cost, but they can be useful in certain circumstances. Bank loans are typically difficult for small businesses to obtain, but they can be had. In particular, you will want to think about dealing with community banks, credit unions, and local banks, as opposed to the big money center lenders. They're just harder to deal with. And certainly you should think about SBA financing if you're in the market for seeking a loan. They will either provide financing directly through some of their programs or by supporting bank lenders who will make loans to you, either through banks or through some of the non-traditional bank lenders like on the Cape Coastal Community Capital. And if you are interested in trying to see if you can get SBA financing, you can go to their website, www.sba.gov, and you can use their lender match program, in which you will enter your information and it will go out to participating banks to see if there's anybody interested. You can often find available financing or leasing from equipment vendors, which I mentioned earlier. If you're buying a business, you may think about trying to obtain some seller financing, where the seller of the business takes back paper for part of the purchase price of the business. And there are online lenders, places like Cabbage, who are very flexible. They are quick to respond. If you have a cash need, the cash gets funded right into your bank account. And they are more flexible, perhaps, than traditional banks. Be aware that they can be expensive because they will charge interest, but they will also charge a fee. And if you don't have the loan out for a very long period of time, that fee can be a pretty hefty percentage of the loan that got made. So proceed with caution, but they can be valuable sources of potential financing for you. People ask me about crowdfunding all the time. It's available, but it tends to work best for very special circumstances. Things like people who have need for funding to cover medical expenses. It requires a significant effort. You need to put videos together. It takes a lot of time, and they don't work generally well for the run-of-the-mill small business, but they are available. And if you have questions about any of this, you can certainly feel free to reach out to a SCORE mentor for help. Now, as I mentioned, bank financing can be difficult for new businesses in particular. What will the bank look at? Well, they generally will call it the 5 C's. Banks are not in the business of making loans and not getting repaid. They'll want to look at what collateral you might have available to support repayment of the loan, whether that's in your business or your personal assets. And most typically, you will be required as a small business owner to provide a guarantee of the loan that gets made. Not necessarily the case that the bank wants to sue you for it, but they want to make sure that you understand that they anticipate being repaid and that you have your own personal assets supporting the loan. I remember the first time I had to do this, I really had to sit and think hard about it. But I recognized that the bank wanted to know that I was confident in the business's capacity for success. And so I ended up signing it. The bank will also look at you. They'll look at your experience, your business plan. What are your relevant management and business skills to show that you will be able to make this business a success? They'll want to make sure that you have really thought hard about the business, which is why they want to see a business plan. And they will absolutely look at your personal credit. Your credit rating will be very important to them in terms of considering a loan to a business that you own. They'll think about the conditions, the general conditions of the economy, and what are the external threats to your business in particular, whether that's new competition coming into the marketplace, heightened regulations, tariffs, or other things that might be in the external environment that can affect the opportunity for your business to succeed. Most importantly, they're going to look at the ability of the business to repay the loan, both the historical performance, if there is any, as well as the anticipated performance. So your cash flow forecasts for the life of the loan are going to be among the most important documents that the bank or any lender is going to want to look at. And they're going to want to know what capital is in the business, what is the equity in the business, and what reserves do you have available to deal with difficult issues. A couple of final tips. It's very useful for anybody in a small business to establish a banking relationship. That's even if you're not trying to get a loan. Remember, I said you're going to try to set up a separate bank account for your business. Well, when you do that, you should take the opportunity to meet with a bank officer. Just don't go to the teller and get the documents. Meet with a bank officer. Explain what you're doing. Explain what your business is and what you hope to achieve. And meet with that loan officer or that bank officer periodically, because you want to establish that relationship. It's much easier down the road if you need to consider getting a bank loan to get one if you're not walking in cold without any existing relationship. And as I said, you're most often for a small business better off dealing with a local bank, a community bank, a credit union, a non-traditional lender like Coastal Community Capital. You should try to establish standing merchant credit for supplies. Just make sure that you have people who are supplying you and giving you 60 days to make the payment. And most importantly, if you can, consider working capital financing. Now, okay, that's jargon. What does that mean? Well, if a lender gives you a working capital financing commitment, it means that they agree to loan you money at your request up to a certain amount. Let's say you go to a bank and you get a working capital commitment for up to $50,000. What that means is that at any point in time, you can go to the bank and say, I need cash, and they will loan you up to $50,000. That's what that commitment was. It's whatever the dollar amount was of the commitment. You'll pay a fee for that as a percentage of the undrawn amount, and you'll pay interest on the loan as an outstanding. But it gives you a tremendous insurance policy to deal with unexpected cash flow shortfalls, seasonally low cash flow, and the like. You will be required typically to pay that loan back in full at some point in time during a 12-month period, and to keep it at zero for at least 30 days. So let's say you set up a working capital financing line of credit in January, and it's outstanding for a full year. In March, because you want to buy some supplies, you borrow $20,000 on it, And you then have to pay that back before the end of that calendar year in December. Once you do pay it back, you can't borrow it on the commitment again for 30 days, but then it would spring back and be fully available to you. So it's a very flexible tool for a small business to have in their toolbox. And if you want to talk more about how you consider trying to get that, you can certainly talk to any of your SCORE mentors who can identify for you more specifically how that works, what it means, and what financial institutions you might have most success in approaching. The newer online lending sources that I spoke about earlier deal with this as well and can be very valuable sources of money. And most importantly, work on establishing a good track record for your business, for your future needs. Make sure that you are keeping good business records. Make sure that you have adequate financial systems in place. Make sure that you're paying your bills on time. And make sure that you keep in contact to develop that banking relationship. And you'll put yourself in a much better position to deal with cash flow problems that you may or may not experience. So that's what I wanted to cover. Be happy to answer any questions that anybody might have.
I don't have any questions posted, Jim. You did a really good job, apparently, explaining everything. So, yeah, certainly if somebody has any questions, can we get those into chat? There was one in chat, but I think you covered it when you got to the financing slide. So, yeah, if you have any questions about anything Jim's talked about, please get that in chat right now, and we'll get that read out and get that answered for you.
And I am not disappearing from the face of the universe. My email address was in the second slide in the deck. And when Teresa sends you the link to the recording, you'll be able to see that. So if you have follow-up questions and you want to just fire them away, go right ahead. I'd be happy to answer them.
Okay. Well, I don't see anything posted, so I just want to thank everyone for joining us today. We hope to see you in the another webinar in the future. Thank you, Jim, for sharing your knowledge and your experience with all of us today. Bye,
Happy to do
everyone.
it.